Feroze Azeez, the joint CEO of Anand Rathi, who joins us this morning. Feroze, good morning. Pleasure having you back with us here on News 9. Help us understand the mood on Dalal Street this morning.
Good morning, Kartik. Like you read out, some Nifty gainers have had astronomical gains as well. If you look at the market's mood, not on your channel but a couple of channels, it was very evident. Is why I stated that the bounce back was imminent.
Yeah.
Of course, if you look at technical charts, they extrapolate what has happened, but some derivative indicators actually do the opposite. Yes, on Thursday, if you look at the Thursday expiry, when markets had breached 25,000 on the lower side, the index synthetic futures of 24th July were quoting at a 42 rupees premium.
All right.
Synthetic futures being at a premium implies that there is more shorting than needed. So there will be short covering.
All right.
So what do I mean by that is, if you look at the Nifty now, let's assume it is at 25,100. The 24th July if you buy a call and sell a put, that's called a synthetic future long. The extra money over the spot price you pay is called the synthetic future premium.
All right.
This has to be 3 rupees per day. That's the implied cost of the premium. So the Thursday synthetic futures on paper technically should quote at 6 rupees. If it quotes at 30 rupees, that means there's more bullishness packed for this series. So coming back to where the mood of the market is, I think it is at equilibrium for this expiry. Now it is quoting at about 8-9 rupees, Thursday's futures.
All right.
So I would say it's a little wait and watch kind of a expiry for the next 2 days left. But I think Nifty stocks, there are about 17, 18 stocks in Nifty who are above 50p, and some of them further expanding their valuations, as you suggested.
All right, Feroze. Well, we will wait for that Thursday data to see whether the bullish sentiment that you were talking about continues to come back into Indian markets or not. But staying with the derivative space, Feroze, help us understand. Market regulator Sebi has again this time allowed Jane Street, the US-based proprietary trading firm accused of market manipulation, to resume trading after the company has deposited the mandated 4,844 crore rupees in an escrow account. Now, while lifting the trading restrictions, Sebi said the entities involved have been directed to cease and desist from directly or indirectly engaging in any fraudulent, manipulative or unfair trade practice. Feroze, help us understand what really happened with Jane Street. Just simplify that for our viewers. How exactly did Jane Street manipulate markets? And what does Sebi's July 3rd order tell us about the proactive nature of the regulator?
Yes, Kartik. So let me break this down into what did Jane Street do. Jane Street basically did something which legally, to my mind, is not prohibited, but there were no limits to do it, and they had very deep pockets. And a computer can very easily calculate what losses do I have to make in the cash market. And if I were to be ready to make some losses in the cash market, what are the positions to be built in the derivative market to make 5 times the gain as much as the loss?
That's right.
So, all the word derivative comes from the fact that it derives its value from the underlying, which is in the cash market. So if it's a derivative, the price of the derivative is dependent on cash market. So what did Jane Street do is, it started building positions, long positions, on a certain stock. For example, it would have done the opposite as well.
Sure.
In a 1-year time frame, a high-frequency trader would change its position every 2-3 minutes. Now, one of the positions one can take, which was described in the order, was that it built on one of the expiries, Bank Nifty. On that day, when HDFC incidentally had given their results, they had built the position of buy position on the stock. Over a period of a couple of hours. So if you're building and buying a stock in the cash market, parallelly, if you're building a buy put option, if you're buying a put option, it's as good as saying that I'm buying an insurance on HDFC.
That's right.
If HDFC were to go down, you would make money. So what it did was it went long in the cash market and went short by buying put options in the derivative market. And then when it was 2 o'clock or 1:30, couple of more hours for the expiry to happen, it actually dumped all its cash positions and lost a lot of money in the cash market. When the stock and bank Nifty fell, the put options of 1 rupee went to 10 rupees. If it goes to 10 rupees, most of the stop loss orders get breached and they don't get executed. If they don't get executed, all the traders came to the terminal and started punching their buy orders of the put option. That's why the 10 rupee option, as per Black-Scholes, went to almost 100 rupees, for example. So
Right.
you bid 10 crore put options, you've made 1,000 crores here, you've lost 100 crores here, you net 900 positive. And if you get some good coincidental days like that, then making money between these two markets is what Jane Street did. And I think that's why regulator has given it an opportunity by making sure that it puts in 4,800 in an escrow, crores in an escrow, and then here's its case more patient.
Right. But Feroze, like you mentioned, if what the derivative market does and this particular kind of manipulation, which Sebi calls it, is not technically illegal, what is stopping a firm like Jane Street to go ahead and play a similar game once again?
Kartik, see, that's my take. Whether it's illegal or legal, of course, the regulator knows it best. But now coming to, see, when you are in the derivative market, the basic qualification for a person to be in derivative market is to learn the Black-Scholes pricing model, which is a Nobel Prize winning model. What it does is it tells you what's the actual price of a certain option given the underlying parameters. So most of the traders in India or globally, now who are retail investors, don't understand valuation of options. It is like a fund manager. Let's assume there is a fund manager managing 40,000 crores of AUM. If you went and met him and asked him what is discounted cash flow, and if the guy said, I don't know what is discounted cash flow mechanism to value a stock, I would be surprised. I would withdraw all the money which I have entrusted him. But on the other hand, in derivatives, retailers don't even have, they've not heard of Black-Scholes pricing model. What is delta of option? What is the gamma of the option? But people go into it. So coming back to your pointed question, can this happen again? Of course it can happen again. Should derivative participants at least have a basic idea of how options are priced? I think so, yes. So anybody who is not having the time to understand the derivative pricing model should not go into it because the opponent has an unfair advantage of education, right? An option trader will go through a 2-year course understanding synthesizing of options before he steps on the terminal. But retailers are using it as more speculative instrument. And Sebi did that, right? It warned you 3 times, saying that isme mat ghuso, samajhte nahi ho tum. But can happen, may not happen. But I'm so thrilled with our regulator. And after having met a few representatives, not second-hand information, they are so sharp. I'm amazed how sharp Sebi, my perception, unfortunately, was not right up there. But after a few meetings, I think that they understand derivatives. Whatever action they are taking, given the data and information they have, has to be 99% accurate, is my belief after having interacted.
All right. And on that Black-Scholes model, Feroze, I think we have to bring you back and do a masterclass on what exactly that means and how retail investors and traders should understand that model.